For a lot of retirees, the next 4 years could be the most important tax planning window you've seen in decades. This is because the new tax law includes a higher standard deduction and something brand new called the senior bonus deduction, which could add up to major tax savings for those over 65 if you take advantage of this in the right way and while the window is still open. So, in this video, I'll walk you through what changed, who benefits the most, and how to take advantage of this short planning window. And I'll break it down with clear side-by-side examples based on income, show you how this affects capital gains, IRMAA, and most of all, your overall retirement income strategy. I know that a lot of people were upset that this new law didn't completely eliminate taxes on Social Security, and I understand that. And in another video, I'll cover that with a little more depth, and it may make a little more sense why it didn't get included. But the bigger story here isn't just what didn't change, it's what did change. This law has the potential to reshape your retirement income plan. It affects how much taxes you pay on Social Security, IRA withdrawals, capital gains, how you approach Roth conversions. And there's really a whole lot more that we could cover, and there's just not enough room in one video to do it. So now I want to walk you through how this affects retirees across a couple of different income levels. We'll look at what changes for someone with a moderate amount of retirement income and for someone with a higher level of income. And this should help you see where you fall and whether your Social Security benefits could now be partially or fully shielded from federal taxes and to see how it plays out overall. But before we dive into the examples, I've excluded retirees who receive all of their income from Social Security. That group typically doesn't pay federal income taxes under our current law, so the changes of this new bill won't really affect them. And also, if you want more background on how we got here, including what's in the new law, what changed, and why this creates this critical planning window for retirees, I'm not going to rehash all of that in this video. Instead, go back and watch the one that I published as I record this. It was just yesterday. It's called Trump's new tax law. Retirees can't afford to waste the next 4 years. Last time I checked, it had about 900,000 views. So, there's a decent chance that you've already watched this video, but if you haven't, go back and check this out. In this video, I want to focus on what the new law actually means for retirees in real-world situations. And to make it simple, we're going to walk through a few examples across different income levels, starting with a moderate income household and then working our way up. And then at the end, I'll talk about how this new law is going to impact capital gains and the IRMAA thresholds as well. All of these examples will be based on married couples filing jointly, since that tends to reflect the majority of retirees that I work with. But if you're single, your income thresholds and standard deductions will be a little bit different. But the overall concepts and planning takeaways will still apply to you as well. So, let's walk through a real-world example of how the new law affects a moderate income retired couple. So, this couple is filing jointly in 2026. Their household receives $45,000 in Social Security. They're taking $30,000 from their IRA, and they have $2,000 in interest income, along with $2,500 in qualified dividends. Now, to give you the most accurate apples to apples comparison, I'm going to show you what their taxes would look like under the old 2017 tax cuts versus the new tax law that was just passed. Since the original tax cuts don't sunset until 2026, this comparison keeps everything consistent. So, here's how the numbers play out. The couple's total gross income is $79,500. That includes their Social Security, IRA withdrawals, interest, and their dividends. You'll also notice their taxable Social Security is exactly the same in both scenarios, the old law and the new law, which is $1,750, which means about 38% of their benefits are taxable. So, their adjusted gross income also stays the same under both versions, $51,550. But here's where the difference shows up, and it's a big one. Under the old law, they would have a standard deduction of $33,200 since they're both 65 or older. That would leave them with $18,350 in taxable income, resulting in a tax bill of $1,585 and an effective tax rate of 8.6%. Under the new tax law, their standard deduction increases by $500. And they also get the new senior bonus deduction of $12,000. That's $6,000 per spouse. And together, that gives them $46,700 in total deductions. Now that brings their taxable income down to just $4,850, and they only owe $235 in federal income tax with an effective tax rate of just 4.8%. Now that's a savings of more than $9,300 just from the expanded deductions without changing a single thing about their income or withdrawal strategy. Now, this is a great example of how retirees in the middle income range can benefit in a big way from the larger standard deduction and the new senior bonus deduction that was included in that new law. Now, let's move up the income ladder and look at how this new law affects a higher income retired couple. Now, in this case, they're receiving $60,000 in household Social Security benefits and they're taking out $50,000 from their pre-tax IAS. On top of that, they have $10,000 in interest income and another $10,000 in qualified dividends. So their total gross income is $130,000. Here's how those numbers break down. Well, just like in the first example, their taxable Social Security is the same under both versions of the law. And in this case, $51,000 of their benefits are taxable. So this means that their adjusted gross income is also identical in both cases, $121,000. And again, the key difference shows up in the deductions. Under the old law, their taxable income would have been $87,800, resulting in a tax bill of about $8,159 and an effective tax rate of 10.1%. But under the new law, thanks to those higher deductions, their taxable income drops to $74,300 and their tax bill falls to $7,239. That's a savings of $1,620, and it lowers their effective tax rate to 9.7%. So even for higher income households like this one, the expanded deductions in the new law can still make a meaningful difference. And for this couple, while their Social Security is heavily taxed, they do end up with more flexibility in their retirement budget just by understanding how the new deduction structure works. And one last thing I want to quickly mention before we talk about capital gains and IRMAA thresholds is the phase out of the senior bonus deduction. I didn't want to get into a long, drawn out example of that here, but this is going to be very important for higher income people or for those people that are doing Roth conversions or planning for any event that creates a spike in taxable income. This is a detail that's fairly easy to miss. And I'll be honest, I missed it the first time myself. When I first read the law, I misunderstood how the phase out worked, and I actually shared the wrong number in a previous video. And thankfully, I caught the mistake and was able to edit it out. But here's how it really works. The law says that the senior bonus deduction is reduced by 6% of the amount your adjusted gross income exceeds $75,000 for single filers and $150,000 for married couples filing jointly. But here's the part that tripped me up. At first glance, you might think that the deduction for a couple, which is $12,000 total, phases out once your income exceeds $350,000. That would be $200,000 over the $150,000 threshold And 6% of $200,000 is $12,000. But that's not actually how it works. The deduction is calculated per person. So, what really happens is that each $6,000 deduction phases out individually once your income goes above the threshold. So, for a married couple, the entire $12,000 deduction phases out at $250,000 of adjusted gross income. That's $100,000 over the $150,000 beginning where the phase out is. And needless to say, 6% of $100,000 is $6,000. And it goes back to a per person basis. So if your income goes above $250,000, the senior bonus deduction disappears completely for joint filers. And then for single filers, it's fully phased out once your income passes around $175,000. Now, this matters a lot because if you're right on the edge, say you're doing a Roth conversion that pushes you out into that $150 to $250,000, you could lose part or all of that bonus deduction, which is going to affect your overall tax calculation and maybe more than you expect. So, now let's talk about how the senior bonus deduction will impact your long-term capital gains. And first, let me go back to the Roth just for a moment. You know, I've always been a big advocate when you're doing Roth conversions. You need to count all of your cost doing the Roth conversion, right? Not just your federal income tax and maybe your state income tax, but you also need to look at what are the other ancillary costs, like your Medicare premiums. And now this is going to add yet another cost. Yeah, it's going to be part of your federal tax. It's going to drive it up, but you need to understand how that interplay is going to happen. All right, let's go back to the long-term capital gains. In 2026, if you're married filing jointly, you can have up to $96,700 in taxable income and still pay 0% on a long-term capital gain. And that's where that first threshold is. So, as long as your taxable income stays below that line, your long-term gains aren't taxed at all. And if you go over that threshold, the capital gain becomes taxable, but only for the part that's over that threshold. Now, you got to remember, though, that threshold is based on taxable income, not adjusted gross income. So, this is where that senior bonus deduction really matters because it lowers your taxable income. And that means that it can actually expand how much of your capital gains fall into that 0% bracket. So, let's say that without the senior bonus, your taxable income is right at 100,000. You're just a little over the line, and now part of your gains are taxed at 15%. But if you qualify for the full $12,000 senior bonus deduction, your taxable income drops to 88,000. That puts you well below the threshold, and now your capital gains could be completely tax-free. So even though the senior bonus doesn't directly change the capital gains tax rules, it does give you more room in that 0% bracket, and that can lead to some big savings, especially if you're selling investments or rebalancing your portfolio. You know, this is one of those subtle planning levers that can make a big difference, but only if you understand how the pieces stack together. So, for example, let's go back to the moderate income couple we talked about earlier. They were receiving $45,000 in Social Security benefits, taking $30,000 from their pre-tax IAS, and they had a small amount from interest and dividends. But now, let's say they sell an investment and realize a $75,000 long-term capital gain. Under the old Trump tax cuts, this pushes their AGI up to $147,150. And after subtracting the standard deduction, they're left with $114,950 of taxable income. Because their income is now higher, 85% of their Social Security becomes taxable, which adds a little bit more to the AGI and ultimately increases their tax bill. So in total, their federal tax owed comes to $6,647, and of that, about $2,678 is directly due to the capital gain being partially taxed at 15%. Now, under the new Trump tax cuts, their AGI is still the same. We're not changing the income here, but what's different is the deduction side of the equation. With the larger standard deduction and the senior bonus deduction, they get to subtract more from that AGI, which means that their taxable income is lower and more of their capital gain stays inside the 0% bracket. As a result, their overall tax bill goes down, and a portion of the gain that gets taxed at 15% is now a smaller amount. So, even though the new tax didn't change how capital gains are calculated, it indirectly creates an opportunity to pay less tax on those gains just by lowering your taxable income. That's why understanding how deductions and income stack together is so important, especially when you're planning a large investment sale in retirement. So, now let's talk about how this new law impacts the IRMAA surcharges. That's the income related monthly adjustment amount, and that's the additional amount that you pay for Medicare Part B and Part D if your income crosses certain thresholds. And here's the key point here: IRMAA is based on your modified adjusted gross income, not your taxable income. That means deductions like the standard deduction or the senior bonus deduction are not going to reduce it. Your modified adjusted gross income for the purpose of the IRMAA thresholds starts with your adjusted gross income, and then it adds back certain items like tax exempt bond interest, that income from municipal bonds, but it does not subtract deductions that happen after AGI is calculated. The standard deduction and the senior bonus deduction are both considered below the line deductions, where that line is AGI. So they lower your taxable income, but not your modified adjusted gross income. So while the senior bonus deduction may reduce your tax bill or help you qualify for the 0% capital gains rate and do a few other things, it's not going to help you avoid IRMAA. So, if your AGI is high enough, you could still face higher Medicare premiums, even if your taxable income looks modest on paper. That's why it's so important to understand which parts of your plan affect your taxes and which parts affect your Medicare cost. They don't always move together, and if you're not paying attention, you can lower your tax bill in one area and still trigger hidden cost somewhere else. And one final note: these enhanced deductions are only guaranteed through 2028. That's why now is the time to plan proactively, not just for this year, but with the next few years in mind. So here's the bottom line. For many retirees, the larger standard deduction and the new senior bonus deduction is going to create some real tangible tax savings. And if you understand how these changes interact with your Social Security, your investment income, and your Medicare premiums, you can use them to make smarter decisions, not just this year, but over the next several years. This is a moment where the details matter. And getting your strategy right could mean paying less in taxes, keeping more of your income, and who doesn't want to do that, and avoiding unnecessary Medicare cost, all while building more flexibility into your retirement plan. Thanks so much for watching.